Good day, ladies and gentlemen. The last time I did a little presentation was in January, and we discussed some of the long-term performances that were generated by the market and that we'd been able to participate in as investors. Where you'll remember that over time, equities performed the best, followed by bonds, followed by cash. So that would be generally what you would tend to expect over the longer term. However, over the shorter term period, events take place in markets which can mean that those performances are interrupted, where you have periods where cash does best or bonds do best. So I thought it would be a good idea to just reflect on the last year. We've had a number of fairly dramatic events within market history taking place. So I thought we would have a look at some of those events over the last 12 months or so. So the first thing is that about a year ago, we were just in the beginning phases of the war in Ukraine. Markets reacted, certainly overseas, pretty violently to this. You'll remember that sanctions were imposed on Russia. A lot of big businesses suddenly found that their Russian entities were needed to be closed down in a hurry. There was a massive spike in the oil price. Inflation was taking hold. Food prices were rising. Of course, Ukraine is a significant grower of wheat. And just as in general, the geopolitical climate deteriorated fairly dramatically. So if we think of this geopolitical climate, for me, one of the most prosperous times in markets was post the wall coming down, where we had Gorbachev, we had Glasnost. That was then followed by China joining the World Trade Organization. And you just had a general well-being, sharing of information, growing the world economy together. And this just seemed to start unraveling, let's put it that way. It has been unraveling really since Trump, I think, but it's continued to unravel with this invasion of Ukraine. And of course, South Africa has recently got caught up in this whole story with its question of its non-aligned status within this environment. So it certainly is not a great environment for equity markets. It's not a great environment for the world, full stop. We sort of harking back almost now to the period where of the Cold War, and certainly the news that comes out of on global news channels, it doesn't look like we are anywhere close to resolving these issues. In fact, they just seem to be getting worse. So certainly not a great backdrop. The immediate consequences of that for markets, other than the destruction of value of Russian assets and other assets around the world, was that inflation took hold. So we've seen very dramatic rises in inflation, more so than the world has experienced in a generation or more. And this, of course, has resulted in central banks who initially thought that the inflation rises were going to be a temporary phenomenon. These inflation rises have become more entrenched, and as a result, central banks have had to act very rapidly and very suddenly in increasing their interest rates. So you would be aware that the UK has experienced recently inflation above 10%. US has got as high as 7-8%. South African inflation rate has risen above the target range for the first time in many years. I happened to read this morning that Argentina raised their interest rates by 6% yesterday in order to combat inflation of 97% per annum. So these are the kinds of news flashes that are coming out, and rising interest rates raises the cost of capital, and it's always not a very great time for equity markets when interest rates are rising. The other consequence of this fairly significant and rapid shift in monetary policy has been what we would refer to as the unintended consequences. And that unintended consequence first manifested itself with the demise of Credit Suisse. So Credit Suisse had been in difficulty for some time. There'd been significant mismanagement, and suddenly they got themselves into trouble. There was a run on the bank, and the Swiss authorities stepped in and forced a merger between Credit Suisse and UBS to create a mammoth banking giant in Europe. So UBS is going to have to sort out all the problems within Credit Suisse. But that wasn't the end of it, because next thing it flowed over into the United States of America, and we started to have difficulties in what have been referred to as the regional banks. Silicon Valley Bank is one of the names that you would recall from news items. And yes, there was some mismanagement there, but also there was a run on the deposits of these institutions. They had taken deposits, very simply speaking, invested them in long-term bonds in the United States of America. Because of the increase in inflation and interest rate, long-term bond yields had risen very dramatically. And as a result, they had a lot of book value losses on their balance sheet. And so suddenly these banks started to, there was a run on the bank. And as you know, whenever there's a run on the bank and depositors flee, of course, they get themselves into trouble. And so therefore the US have been putting out fires all over their regional banking industry. There have been some fairly dramatic losses of capital in that environment. The market is now fretting over potential knock-on effects into commercial property market. So these sort of unintended consequences of the very dramatic change in monetary policy are slowly beginning to manifest themselves. On top of this, in the United States right now, we are getting to a debt ceiling debate, which speaks more to the inability of the Republicans and the Democrats to agree on just about anything in Congress. And with a very close number of seats on either side of the House, this looks like is something that is going to potentially disrupt markets in the next couple of weeks or so. Another unintended consequence of these crises that we're experiencing. So globally, the world is in a far more difficult place than it has been for many years geopolitically. We're also having some sort of sense of banking crisis, and that's always a very, very dangerous period, because when banks get into trouble, generally speaking, the economy gets into trouble. They are the lubrication and the mechanism by which capital is reallocated. So it is an environment in which to be cautious. Here at home, of course, we have some dreadful politics and some very, very horrific results coming through in our among our SOEs. So the Eskom crisis, as well as the Transnet crisis, has been seen and felt in the earnings results that have been published in the recent few months by a number of companies, where the costs of load shedding are becoming obvious to the market. The problems that retailers are experiencing with the cold chain, significant cost of running their generators, diesel, etc., as well as the Transnet difficulties. I read yesterday there was another derailment on the Richards Bay line. Transnet badly mismanaged, Eskom badly mismanaged, along with a number of SOEs. So it is an environment. These are critical components of the South African economy, critical for business that they work. In due course, one would imagine that, like the post office, these will become irrelevant and be replaced by private sector alternatives. But certainly in the immediate term, there is not a lot of hope with regard to Eskom solving its problems, nor Transnet for that matter. And on top of that, we seem to have a country which is leaderless, where unfortunately the internal politics so evident in the appointment of the electricity minister, where I don't know whether he's going to be competent or not, but as long as Gwedi Mantashe and Pravin Gordhan are fighting for space and he's being excluded or not allowed to do anything, or what are his role, where's his authority, and the president just seems to be absolutely stum on these matters. Doesn't say anything, doesn't seem to get involved, just seems to be covering himself, scared to make a decision, and that's an environment in which the country will just blunder from one crisis to the next, as we are currently seeing with the Lady R and one of our army leaders currently visiting Moscow. So it's against this rather depressing background that we have had markets that have done, I think, significantly better than we could have anticipated. So if we have a look at the various asset classes, we'll see that over the last 12 months, cash returned 5.9%, bonds just over 6%, property a laggard, only 3.2%. Obviously, the cost of keeping the malls open with the diesel generators, etc., has impacted on their cost line, and therefore property values in general have come under pressure. But South African equities have done well in this environment, 12.5%, significantly better than what one might have thought. It hasn't been a broad-based performance. A lot of that performance for the South African equity market comes out of our big cap companies. So Naspers has had a very good 12 months. So is Richmond, up over 80% over the last 12 months. The gold shares have done well. Some of the resource companies have done reasonably well. And then companies like Bidcorp with a large offshore footprint have also done well. So quite a narrow market in terms of what's generated that 12.5% return. But nevertheless, for the JSE to deliver 12.5% in the environment that we are living through is, I think, quite extraordinary. As you would have expected, of course, offshore assets have done well. The rand has weakened significantly. It's weakened because of politics. It's weakened because also, if you think that at the moment in our funds, we are able to collect a return on very short-term dollar investments of around 5.5%, whereas in rands, currently, if you're on call or on short-term deposit, you are generating returns of 7.5%. So that very small difference in yield, certainly if you were an exporter, you would rather keep your money in dollars, earning 5.5 than bringing it back to rands. You remember, it wasn't 18 months ago where that difference was significantly greater. So that does, of course, help the offshore assets. Offshore bonds, better than local equity at 13.8%, offshore equity at 16.4%. But you will notice that offshore cash also delivered 16.4%, which effectively tells you that offshore equity delivered, if you just look at equities in dollar terms, it was zero, because these are all rand returns. So the rand returns from overseas equity and overseas cash was exactly the same, which means that the equity markets were static. So this is the environment, or these are the asset classes that we can choose from and to build our portfolios. And our performance, given those asset class returns relative to South African inflation, I hope you will agree, is commendable under the circumstances. So the Personal Trust Managed Fund over 1 year has delivered 11.4% return, Prudent Fund 10.1%, and our Conservative Managed Fund also 10.1%, against an average inflation rate of 7.1% over that period. You might say, oh, well, you're choosing a specific period, and fund managers often do this. They wait for the perfect period to do their presentation, where there was a low base that they were starting from. But what I will show you is that I'm not choosing just that period. I've also taken a 3-year period just to show you that it's not just over a very short period of time. Over 3 years, Personal Trust Managed Fund delivered 13.6%, Prudent 10.8%, Conservative Managed Fund also 10.8%, as against an inflation rate of 5.4%. So I'm very happy that we've been able to beat inflation. I'm very happy that we've been able to deliver those returns for our retired clients in what is a very, very difficult time for investors, and a very difficult time for all of our confidence in South Africa and indeed the world. So we will endeavour to continue to do our best in these tricky environments to try and continue to deliver inflation-beating returns for you, our investors. Thank you very much for your support, and all of the very best.